Australia's non-life insurance market insurance segment has been resilient against an increasingly complex and interconnected risk landscape. Here to discuss a new report on Australia's non-life segment is Chee Yun, financial analyst, AM Best. Chee, the report notes that Australia's non-life industry reported improved profitability in fiscal year 2025. What drove that?
Yeah, definitely. With the improved profitability, we note that this stems from both improved underwriting profitability as well as robust investment returns. With improved underwriting profitability, we note that this has really been driven by sustained periods of top-line repricing. The industry as a whole have experienced high above inflation premium rate increases in the past 2 to 3 years, particularly in the motor as well as the property sector. This was done in response to the high inflationary environment that we were in back then. We also had a few large weather events, particularly in calendar year 2022 and 2023, all of which has inevitably, impacted reinsurance premiums as well. Therefore, with this sustained top-line repricing, it has really boosted underwriting margins for general insurers. Other than repricing, the industry also benefited from the relatively benign natural catastrophe environment, definitely relative to the previous record-breaking years. And as we know, extreme weather losses is a big cost to the industry, with Australia's exposure to natural perils, which has been further exacerbated in recent by climate change, urbanization, and development in high-risk areas as well. So, with constant repricing, benign natural catastrophe environment, we have definitely seen improved underwriting profitability in the fiscal year 2025 results of the industry, as well as the top 10 players of the industry as well. On the investment returns front, insurers have also reported robust investment returns. They have benefited from the strong equity market performance. Australian equities have also performed very well in recent as well. Fiscal year 2025, interest rates were still relatively high during that period, so insurers can still enjoy good returns from their fixed interest investment instruments as well. So on the investment front, insurers definitely also had a good year. Underwriting front, they also had a good year. So all in all, this have driven improved profitability in fiscal year 2025.
What do you expect related to pricing trends over the coming year?
Yeah, we have mentioned in the report that, after many years of sustained premium rate increases, we have seen signs of market softening. Some of the drivers of this, include, firstly, there is increased profitability, as we have discussed in the first question. As a whole, with the relatively benign period of net cat losses in Australia, insurers are also able to attract more favorable reinsurance premiums and terms. So as such, what we are seeing in the market is really increased appetite from insurers, influx of both local as well as international capacity, all of which have led to increased market competition and therefore, downward pressure on pricing. But of course, with the current geopolitical situation, I definitely have to caveat that things remains very fluid with the ongoing conflict in the Middle East, which has introduced significant uncertainty and risk to the insurance sector. The impact of the conflict, includes supply chain disruption, material cost inflation. To actually support the industry, the Insurance Council of Australia, ICA, they have actually declared the Middle East conflict as a significant event on 3rd March. They have also tasked its most senior industry committee to actively monitor the evolving effects of the conflict and also to develop mitigation strategies. So, definitely while we do see some trends of the softening market, I would definitely highlight that, the ongoing Middle East conflict has definitely introduced additional uncertainty to the forward-looking pricing trend of the industry.
What are some key regulatory developments in the industry and its related impact?
Yep. Definitely on the regulatory front, we do see that there remains to be robust regulatory oversight, supporting the resilience of the industry. I would just highlight two key regulatory developments that we have highlighted in our report. The first one being the CPS 230. With the CPS 230, we are really looking at, operational risk management, strengthening of operational resilience, with the three key aspects being, firstly, business continuity plans, secondly, management of material service providers and its related risk, and lastly, the maintenance of critical operations within tolerance levels during disruption. I would highlight that, while the standard commenced 1st July 2025, for pre-existing contractual arrangements with service providers, there is actually a transition period until the earlier of the next renewal date of 1st July 2026. The second regulatory development that I will highlight is reinsurance. So EPRA is in the process of modernizing the general insurance reinsurance framework, potentially exploring alternative reinsurance arrangements. We do expect that this will help to ease affordability pressures, reduce regulatory burden, and definitely, improve efficiencies by streamlining existing regulatory processes. And in terms of timeline, EPRA aims to release the final versions of the prudential standards, guidance, and reporting standards in the first half of 2026, with a target effective date of Jan 2027. So, yep, these are the two key regulatory developments that we have highlighted in the report.
That was Chee Yun, financial analyst, AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.